Hello everyone, this is Professor Kent. Today's recording is homework questions for chapter 17. The first question that we're going to work on is exercise 17.9. We're going to do part A and we're going to do part B. So 17, what the question is asking us to do is we have to calculate a diluted earning per share for the year December 31st, 2020 and rounded to the nearest dollars. Before we could do the diluted earning per share, we needed to do basic earning per share before we can move to the diluted earning per share. And in order to do a basic earning per share, what we need to do, we need to calculate our first component is your net income. How do we calculate net income? Your net income will be, most of the questions is given to us, but in this case it's not given. In 2019, Capstone Limited issued a bond. So we issued a bond in 2019. The company had a revenue of 75,000. So we have a revenue, that's the company's revenue, which is 75,000. And revenue minus expenses is your income before taxes. So, and expenses, we have our expenses which are in 2020 not including interest expense. So what we have is, in other words, we have other expenses and then we have interest expense. My other expenses was $40,000. My interest expense is on the bond. In this case, we had the bond was outstanding for the full year. If it was outstanding for full year, they want us to calculate it times the 8%, and that will be your 4,000. If I add the both expenses, that's the income before taxes. In this case, it is 31,000, your income before taxes. So that is your income before tax. Then what we have is tax expense. In our case, our tax expenses is 25%, and which is 7750. So that's my expense. And then what is your net income? My net income in the first question is 23,250. So net income minus your preferred dividend divided by number of shares outstanding, number of weighted average shares outstanding, weighted average shares outstanding. So now how do we do the basic earning per share? Let's calculate it before we could do a diluted. So our basic earning per share is equal to your income, 23,250. We don't have any dividend. In this case, they told us in the question that we have 1,000 common share outstanding, and if there were 1,000 was outstanding, that'll give me earning per share of $23.25. Now we only have a one convertible, and what we do is something called what if they were converted. What if they converted? What if method. So when we do a what if method, we test it to compare it. Would that make my earning per share go down, or would it make my earning per share go up? When I do that, when we test it, what we do is we have $50,000 bond. We pay them 8% interest. On that interest, it goes onto my income statement. So you have 1 minus the tax rate, and then it was outstanding for the whole year of 2020, and divided by, if we have 50,000 bonds, each 1,000 bond is converted into 100 shares. So that's what the question is telling us. Each 1,000 bond is converted into 100 shares. So in this case, when we do that, it tells us how much the bonds can be converted. In this case, it will be 5,000 at the bottom, and at the top you will have a $3,000. That's the dollar value. So when I do that, what I'm going to do is, first I'm going to test it, and I'm calculating earning per share, and that is 6.6. Is this, we compared to the basic, is this a lower? If your answer is lower, then if your answer is yes, it is called, then it will be included in your, when you're calculating diluted earning per share. So that's part A. We're going to calculate. Now we're calculating diluted earning per share. So when you're doing a diluted earning per share, the first thing we start off with is your basic. Your basic does not change, it stays the same, and that is 23,250 divided by your 1,000. What did we get? $23.25. Since we only have a one security, one bond that can be converted into shares, so what we're going to do is now we're going to take it to the next level. You start with the basic 23,250, and then at the top you're going to add the 3,000. At the bottom, what are the number of shares? It is 1,000, and the number of shares that goes with the 3,000 is your 5,000. And you're going to rework out. What are you going to rework? Earning per share, but this is called a diluted earning per share. It will be lower than your basic earning per share. In this case, when you add that, it will come up with a $4.38. So that was the answer to part A. So now they changed the question. They're saying that the bond wasn't issued. The bond was issued on October 1st. And when are we calculating basic earning per share? We're calculating it on December 31st. So let's work it out and see if I could redo this. So in this case, we have to redo it. How do we redo it? Let's recast the financial statement. So we have to redo we need to redo our income statement. Our revenue did not change. Now a little bit changed because now what happened is the bond wasn't outstanding for the full year. It was only outstanding for the 3 months. So then my next one is my expenses. And then we have other expenses. Then we have our interest expense. And my other expenses are about 40,000. My interest expense is bond is 50,000. We pay 8% coupon rate, multiply 3/12. How did we get that? Because they said the bond was issued on October 1st. When are we producing this financial statement? On December 31st. And how many months is there? There's 3 months in there. So in this case, my interest expense will be 1,000. So that will give me 41,000. Now these are my expenses. You have an income before taxes, and that is your 34,000. We pay tax expense, and that tax expense is equal to your 8,500, which is 25%. And then what we have is net income. So net income is what we need to calculate our basic earning per shares, because I need basic in order to do the diluted, so because I needed a comparison. So first I'm going to do basic earning per share is your net income minus your preferred dividend. Our preferred dividend is equal to 0 divided by number of shares outstanding. In this case, it's 1,000. So it is $25.50. From there, what we're going to do is now, what if the bond was converted? What if bond was converted? So what if the bond was converted? So how we're going to do that? So now, of course, our numbers are a little bit different, but not same. So in this case, what we have is we have 50,000 bonds, and then we pay 8% interest. Since it's an interest expense, 1 minus the tax rate times 3 divided by 12, because we issued the bond on October. It can only be converted from October 1st to December 31st. So in this case, 3 divided by 12. At the bottom, we have 50,000 bonds. Each 1,000 bond can be converted into 100 shares, and then we multiply by 3/12. Whatever we do at the top, we have to do it at the bottom. Then what we get is, at the top we'll get 750. At the bottom is number of shares, and number of shares is equal to your 1,250. And then when we test it, it is 0.6. And then is this lower than the earning per share? Yes. If it's a yes, should be included. It is diluted, and then we needed to recalculate our diluted earning per share. Now how do we do that? I needed to raise the other thing, so let's do that. In this case, we are working on part B. We're part B, And when we're doing part B is that your basic earning per share is 25,500 divided by your 1,000. What does that give me? It gives me $25.50. That's your basic. And then what we have to do is you have to do your next calculation. In this case, we only have a one diluted securities, and the top you add it to 750, at the bottom you're going to add the 1250, but our basic was 1,000. So in other words, whatever we did under basic, you repeat that, and then you do your next one is 7, you add it and then do your next one. So let's see what we did in this case. Let's see. So now if we put everything together, add the top numbers, add the bottom numbers, what you're gonna do is you're gonna get an earning per share, which is going to be called diluted earning per share. So this is diluted, and this is your basic earning per share. So we have two things, basic, and but the question is asking for you to do a diluted earning per share. So we did 9. So the next one we are gonna do is 9, and then the next one we had to do is 12. So let's do the 12 and see what happens. In this case, we stick with the same and see what the question is asking us to do. We're going to do A and B. Again, the question is asking you to do diluted. We cannot do diluted earning per share till we calculate our basic earning per share. To do a basic, what we needed to know what the company's net income is before we could do anything. So let's do that. Did the question tell us the net income? Yes, they said that Draper's net income was 200,000 and its tax rate is 25%, and the company has 100,000 common shares outstanding. So let's do our basic. Our basic earning per share is equal to your the basic earning, my net income is 200,000. Do we have any common shares? No, we do not. Preferred shares. So then my preferred dividends is 0 divided by number of shares outstanding. In this case, it is 100,000, and my basic earning per share is $2. We wanted to know what if they were converted. So we have a debt that can be converted. So we are saying, what if they were converted? What if method? So what we are going to do is we're going to do a test. In this case, we have 4 million bond, and we pay them 6% interest, and our rate is 25%. So we issued it on January 1st, where when are we doing it? December 31st. So times 1 minus the 0.25 and divided by what they said is, they said each 1,000 bond is converted into 20 common shares. So what is the value of our bond? 4 million divided by 1,000, and it can be converted into 20 shares. When you do this, what you're going to do is at the bottom number is your 80,000, at the top your number is 180,000. So 180,000 divided by 8,000. What did we get? We got the per share, which is $2.25. We compare to the basic. Are they diluted? No, they are not diluted. They are called anti-diluted. So this is called an anti-diluted. If it's an anti-diluted, my basic earning per share and my earning per share will be same. So if they this is the only one, so then you have to say it. If it's not, shouldn't be included, then your basic earning per share and diluted earning per share will be same, which your basic will be same as your diluted. So basic earning, whatever your basic earning will be your diluted earning per share, because we don't need to include this into our calculation. It's called an anti-diluted. So that was the part A, and the part B is asking you to do something else. So let's see what the B part is asking us to do. Calculate the diluted earning per share assuming the same fact above, except the 2 million. So what they're saying is, it's instead of a debt, the company, instead of having a debt, what they have is they have preferred shares. So basic earning per share is exactly the same. So company could have a preferred shares that can be converted into the into the common shares. So what we're going to do is we are deleting this part from the question, and we're changing that to part B. So basic is not going to be changed, but actually basic will change too, because now we have a preferred share. So let's rework out your basic earning per share. So now let's look at a basic. Under the basic, what we have is we have a net income. So that was your 200,000. We wanted to know, do we have any preferred dividends? In this case, we do have it, and they are cumulative. If they're cumulative, we needed to deduct current year's dividend. So we needed to deduct current year's preferred dividend. How we can calculate it? We have $2 million. That was instead we have $2 million. What we do is we pay them 6%. So they're saying that 6% bond of 6% dividend that we pay. So in this case, that will be 120,000 and divided by your number of shares outstanding. In this case, it was 100,000. And that gives me basic earning per share of 80 cents. So now, like we said, that we have debt that can be converted into we have a debt that can be converted into shares. We have preferred shares that can be converted into common shares, and we could have option that can be converted into common shares. So these are the things that can be debt can be converted, what preferred shares and option. In this case, we have a preferred share that can be converted into common shares. So when we do that, what we have to do is we needed to test it to see if they're diluted or anti-diluted. So we needed to see if they're diluted or anti-diluted. Again, in order to do a test, if this bond was converted into shares, so if they were converted into shares, we need to test it. So when you're doing it at the top, you have 2 million preferred shares. The value of your preferred shares, we pay them 6% dividend. We will no longer pay them the dividend. We don't do 1 minus the tax here, because dividend is an after tax income. So in this case, the top number is 120,000. What is the bottom number? They said that each 1,000 preferred shares are convertible into 5 common shares. So how much the value of your preferred share is $2 million. So each preferred shares are convertible into 5 shares. So in this case, what would that give me? That will give me 100,000. If I put the 100,000 in here, that will give me $120. So now if you look at it, you are comparing it to the earning per share. We needed to know, is this a diluted or anti-diluted? When we tested, it is more. If it's a more, it is called an anti-diluted. So anti-diluted securities are not included into the calculation. They are not included into the calculation. So we want the earning per share to go down. We don't want them to go up. So that's our next part of the question. Let's see if we can get to the next ones. Now we are going to, when we do the next one, we're going to do the options. So what the question is options. The option can be converted into shares. Now all I'm going to say, the call option, or which is called the purchase option, they will always be in money. When you're testing it, it will always be in money. If it's going to be money, they should be included into the calculation. If they are not in money, then we do not include it into our calculation. So that's what we do. We do not include them into our calculation. So let's see what the question is asking us to do, and then we can go from there. What do we do? Calculate the diluted earning per share for December 31st, 2020, rounded to the nearest dollar. Before we do that, we needed to, anytime you do that, you have to calculate the basic first before you could do any diluted. So let's do the basic first, basic earning per share. So they think Standard Corporation's net income for 2020 is 150,000. The only potential dilutive security outstanding were our 1,000 call option issued during 2019 the each. Okay, before we read that, before we go further, so what is my net income? In this case, my net income is 150,000. Do they have any preferred dividend? In this case, the preferred dividend was 0. How many shares are outstanding? They have 30,000 shares outstanding. Do what we know first before we could go further. So my basic earning per share is 5. When we are doing options, we said we use a treasury method. So when we're doing a treasury method, what we need to do is we needed to do some calculation. So when we do the calculation, we want to know if they are in money. When they're in money, what we have is we have something called the market price, and then what we have is a exercise price. So exercise price, those are the two things. So market price and your market price and your and your exercise price. Now we're going to read it. The only potential diluted security outstanding was for 1,000 call option. So we have a call option. Call option is to buy. If it's a buy, how many share? What is the option for 1,000 call option? With each option was exercisable for 1 share for $20. So the exercise price is $20. What we needed is we needed a market price. So we wanted to know, should we exercise this option or not? So the market price is 25. If you were to buy it today, the price you're going to get is $20. So then, is this in money? Yes, it is in money. If it's in money, you needed to do the calculation. So again, the calculation is simple. So what happens is that you, either way you wanted to do is, if you do it the book way, or any the book, if you wanted to do the way I showed you before, there's a three things that you have to kind of put it out and then see what you could do with it. The first thing you're going to look at is, I'm going to do exactly what we did in our example. Proceeds from exercise. So how many shares they're exercising? $1,000. So proceeds. So from the company point of view, you are going to give them $20. So if the option was $1,000, so then what you're going to do is you gave them the so $20. Sorry, it is $20. So if you do it option, that will be your $20 equal to your $20,000. So that will be the money, that proceeds will be that. So what they're going to do is, in other words, how many shares is going to be exercised? In this case, number of shares exercisable. So in number of shares issued upon exercise. So if exercise, how many shares we're going to issue them? We're issuing them $1,000. So in other words, then what you're going to do is you're going to use treasury method, and what you're going to do is you're going to treasury shares purchased with proceeds. So the proceeds was 20,000. We're going to take that $20,000. We're going to purchase our own shares divided by 25. So in this case, what is that is going to give you? It will give you $800 shares. So treasury the word here is treasury share purchased with proceeds. Treasury shares purchased with proceeds. When you do that, your proceeds was $20,000. The market price of the shares is 25. So how many shares can you purchase with the proceeds that you got? In this case, we got 800. So incremental, then the difference between the both will be called incremental share. So incremental shares, in this case, how much is the incremental shares? The difference between the both is $200. So we got from the company point of view, we got a proceeds, we purchase our own shares. So when we're doing the are they in money or not, what we're doing it, at the top number will be 0, at the bottom number will be 200. When you test it, you have $20,000. You use that $20,000 to purchase your own shares. That will be top number is 0. The bottom number is the incremental share. So in this case, the bottom number is your incremental share. It will be 0, and if it's a 0, it will always be ranked first, and they will be included into the calculation first. So that's the thing is will be in, it'll always be in money. When you have a call option, will always be in money, because otherwise you will not exercise it. Now B, they changed the question. What they say is that no, they did not change it. All they did is they changed the date. So let's do that. It's saying assuming that the 1,000 call option were issued instead of November 1st rather than the 19th. So then when are we doing this diluted earning per share? We're doing it on December 31st. So when they're doing it, all you have to do is nothing else changes. All we have to do is multiply by this from November, and when was it? November 1st. November 1st, so the month of November and December. 2 divided by 12. In other words, is this in a money? Well, of course it will always be in money. So and oh, we didn't finish the first question, sorry. Let's do the before we do that, we needed to calculate the diluted earning per share. I didn't do that, so let's calculate our diluted earning per share. First, what you're doing is basic. Our basic is 150,000 divided by 30,000, and that gave me $5. That's my basic. Now what we're gonna do is we start with the basic now this is the first one. Top number is your 0, that's the dollar value. The bottom number is your $200, 200 shares, not dollar, 200 shares, and we have 30,000 shares outstanding. If I put them together, that will give me diluted earning per share, which is $4.97. We want our earning per share to go down. That's why the options will always be in money when we think of it. Now we're going to do part B. Part B is exactly the same. The only thing changed is number of the incremental share changes. In this case, your whole calculation is exactly the same. The only thing is this option was only from November 1st. So sorry, on November 1st, then it's only 2 months. So November and month of December. When I do that, it will be 0 divided by the 33. So incremental shares are 33. It will still be a 0 and it will be ranked number 1. So options are always ranked number 1. So when you're asked to do diluted earning per share, which is B, diluted earning per share, our basic is 150,000 divided by your 30,000 gives you $5 per share. And then what we're going to do is now we can calculate diluted 150,000 plus the 0 at the top. We started with the 30,000 common shares, and we could convert 33 more shares, and that will give me a $4.99. So that will be called an diluted earning per share. So it's making my earning per share go down. So anything that makes your earning per share go down is called the diluted earning per share. If it makes your earning per share go up, it will be anti-diluted. Now what is the C part of the question is asking us to do? C part is asking us to do the put option. So we needed to put is to sell. Would you sell it? So that's what you wanted to do. You wanted to know, you want to make your money. So we have two prices. We have a market price and we have a exercise price. We have a market price and then we have an exercise price. Our exercise price is 15 and our market price is 25. Would we sell? So in other words, we will be selling at 15 when the market price is 25. In other words, the market price is more than what we could sell it for. So we will not sell it because we don't want to lose money. When what the part is here, it's not in money. So it's not in money because you're going to get $15, and if it's you're going to get $15 when the market is at $25. So they are not in money. If they're not in money, we do not need to include it into our calculation. The other part is the price you're going to get is $15. So it's not worth it for you to sell it because these share prices are more. It's not worth it for you to sell it. So the next question that we had to do is 1717. So let's do 1717. Now it's the same thing. You could have option that can be converted into share, and you have warrants that can be converted into share. You wanted to know, are they in money? The theory is exactly the same. So we have an exercise price and we have a market price. So those are the two prices that we're looking for. And then let's see what they are asking us to do. They earned 480,000. So that's my income. So I'm just gonna put that in there too. So that is your basic, to calculate your basic earning per share. Had an average shares of 100,000. So that's my 100,000. The common shares sold at an average price of 23. So the market price is at 23. Also outstanding was 18,000 warrants that could be exercised to purchase. So it's a call option at $10. Are they in money? Yes, they are in money. We're gonna get it for $10 when the price is 23. Are they, first of all, are the warrants dilutive? Yes, they are dilutive. Why? Because they are in money. They are in money because we have the right to purchase. We have the right to purchase the share at $10 when the price is $23. Then they said calculate the basic earning per share, which I was trying to do here. In this case, it is $4.80. So in this case, first one is A. Are they dilutive? Yes, because they are in money. Yes, they are dilutive. Now then what we are going to do, the B part, is to calculate your basic earning per share. In other words, now you have to redo the calculation that we did. So what we did is we got a proceeds when we exercise our rights. Proceeds from exercise warrants. How many warrants? In this case, the warrants is 18,000. We're going to multiply by the exercise price, so they're going to receive 180,000. So number of shares, number of warrants that are exercised, number of warrants are 18,000 warrants. So that's number of warrants. So what we're going to use it, we are going to use the 180,000 dollar value that we received. What we're going to do is we're going to take the market value divided by 23, and then that's how many treasury shares are purchased with the proceeds. So in this case, it will be 7826 treasury shares purchasable, and that will be 78,260. Difference between the both is your the difference between the both is your incremental share. So difference between the both is called an incremental shares issued, and that will be your 110,1071. So that's how much the incremental shares are going to be. Now we have to, are they in money? Yes, they are money, because we already know that they're in money and they're dilutive. So now when you do that, when you test it, you have 180,000 minus the 180,000. So you exercise it and use the same amount to purchase your own share. At the top is 0, at the bottom will be your incremental share. So at the bottom will be it's called an incremental shares that are purchasable, incremental shares that are issued. So in this case 10174, it will still be 0, it will be ranked number 1, they will be in money. So what we need to do is we needed to redo the calculation. Our basic is 100,000, that is $4.80. That's your basic earning per share. From there, what we're going to do is we're going to do our next one, and then our next one is our diluted earning per share. You at the top you add the 0, at the bottom what you're going to do is your your incremental shares that you issued, and what you're going to do is you're going to get earning per share. That will be your $4.36. So your earning per share went down, and this $4.36 is called a diluted earning per share. So this is called a diluted earning per share. And now I know that I did not promise, well, I didn't promise that I will do 17.8. I wanted to do 17.8 because I think it's a very good question, even though it's a big question, but it has dividend, and it has options and bonds. So that's what it has. So we wanted to do number 8, so let's do number 8. So I'm only going to do the basic and the diluted, so I'm just going to leave it here to do basic earning per share. It seems like a big question, but it is not a big question. So it's not a, it seems like a big, but I'm not going to give you the whole thing. We're only going to ask you to calculate the basic and the dilutive earning per share. So now we have accumulative shares. So we know that they given us a dollar value, and we needed to look at that. So in other words, we want to know, did they have paid any dividends? So first thing we're going to do is a basic earning per share. How do we calculate the basic? We have a net income. In this case, I saw it 1.5 million when I was doing this question. Where did I saw it? Oh, it's right here, number 6. Net income for the fiscal year was 1.5 million, 30% tax, and then we have a 1 million shares outstanding. So what we have is we have 1.5 million. That's my net income minus your preferred dividend. And if they didn't pay any, we need to look at it. Are they cumulative? Yes, they're cumulative. If they're cumulative, they don't need to declare it. They're saying there are no preferred dividends in arrears. Preferred dividends are not declared. Even though they're not declared, but they're cumulative, we have to deduct current year's dividends. How do we do it? Number of shares times the $4.25. In this case, it is 106,250 divided by number of shares outstanding, which is 1 million, and that gives me basic earning per share of $1.39. Then what we needed to do is we have quite a few things. We have an option, and then we have a one that is convertible. So we only worry about options and convertibles at this point. And where we're using it, we're using what if. So this dot is connected to number 2, and your options are on its own. So let's do the option, because option is always going to be ranked first in our calculation. So first we have an option. If call option will always be in money, so call option will be always in money. So when we do that, we use the treasury method. Something called a call option is to buy, and we use a treasury method. We want to know if they're in money. If they're in money, they will be dilutive. So option were granted by the company in 2018 to purchase 1,000 shares at $15 per share. Although no option is exercised, the average price. So now we have two prices are given. So we are given exercise. We have to look at the exercise price, and then we need to look at the market price. So we have an exercise price. Our exercise price was 15 and market is 20. So are they in money? Yes. If they are, yes, they are in money. If they are in money, they will be diluted. So they'll be, anytime it will be diluted. So what we're going to do is, what is the option for? Option is to purchase excess, to buy 1,000 shares. So what the proceeds from exercise this option? The option will be how many shares? Options, how many shares? It is 100,000 shares, and then multiply by the exercise price. In this case is 15, and that gives you 1.5 million. So in this case, the company is, what they're going to do is, their number of shares they are going to issue, number of shares issued upon exercise, which is going to be 100,000. So in other words, whatever that is, it will go here. And the next one is shares purchased with proceeds. So number of shares purchased with proceeds. We got company, as a company, it's 1.5 million, and then that's the proceed divided by your market price. Market price is 20, and that gives you the share purchasable with the proceeds. So you minus the 75,000 from it, and then what you're going to do is you are getting your incremental shares outstanding. So we have an incremental shares outstanding, 25,000. If I were to do it, test at the top, we are going to have a 0. How did I get the 0? 1.5 million minus the 1.5 million. 1.5 million equal to 0 divided by your 25,000. That's your incremental share. In this case, it will be 0, and this always going to be ranked number 1. But then we have to go to our next one. We have a convertible bond payable. So we wanted to know what if it was converted. If it was converted, how many shares? So we needed to test it. How we're going to use a what if method. So let's use a what if method to convert it. So what if method to convert it, and we're testing it. When you're testing it, they said each bond was issued at the face value 7% convertible. So what is the value of your bond? The value of your bond is 5 million. So that's the value of your bond. In this case, when you're testing it, you have a 5 million bond. What we're doing is we're paying them 7% interest, 1 minus the tax rate, and that was for the full year. So that's my top number. At the bottom will be your 5 million bond, and they said 1,000 bond can be converted into 50 shares. So 1,000 bonds can be each 1,000 bond can be converted into shares, which is 50. So I'll have to do it at the top. At the bottom we have a number. In this case, it is your 250,000. At the top will be your 24,000. I don't have a number. Let me just quickly calculate it. 245,000. And when I did that, what I'm going to do is I'm going to get your earning per share, which is going to be 0.98. So what you're going to do is when you do that, you're going to compare it to what? You compare it to basic earning per share, and that's what you're you're comparing it to basic earning per share, which is lower. If it's a lower, it is a dilutive. So it is a dilutive. Is this a lower? Yes, it is lower because 0 will be compared to 1.39. It is lower. Yes, it is a lower. It is a dilutive. If it's a lower, it's a dilutive. This will be rank number 1, and this is going to be rank number 2. Now let's put it together and calculate the diluted earning per share. That's the number the next question is asking you to do. I always start with my basic. In this case, it is our basic is 1.5 million, and then we paid a preferred dividend. It was 106,250. How did I get that? I'm just going to show you. We have 25,000 preferred shares. Each we are paying them $4.25 dividend. So that's what we are paying them. We're paying them $4.25 dividend divided by number of shares outstanding. In this case, it was going to be 1,000 number of shares outstanding. What did I get? I got a basic earning per share, and that is your $1.39. Now, which one is my ranking? Ranking 1 will go into my calculation first. So I'm going to do is I'm going to go one more step. 1.5 million, that didn't change. My preferred dividend did not change. I add 0 at the top, and then what do? At the bottom, I'm going to add the 25,000. That's the number of shares that we issued. So in this case, 1 million the and the 1 million and the 25,000. And what did I get? I don't know what I got. In this case, I don't know what I got. So in this case, I got $36. So in this case, it is $36. So is this lower than the basic earning per share? Yes, it is lower than that. So this was my rank number 1. So I'm going to go and take this calculation further and then add my rank number 2 to the calculation. So let's do that. Now my basic, I'm going to change the ink to a little bit. So oh, there it is. 5 million, that didn't change. My dividend did not change. First number was 0, and then that was my rank number 1. You don't need to do this, but I'm doing it to show you. Rank number 2, I take the top number, in this case is 245000. That's my ranking of the top. At the bottom, my number of share is 250,000. Then we started off with 1 million, and my ranking of 1 was 25,000, and then I put it all together, and what is going to get? I'm going to get diluted earning per share. My diluted earning per share will be your, in this case it will be your $1.29. So is this lower than this? Because we want your earning per share to go down. That's why it's called that diluted earning per share. Make the earning per share go down. So the question cannot be any different than these ones. So all you're doing is you're putting it together. So when you could have an options that can be converted into share. You could have a preferred shares, they can be converted into common shares. You could have a debt that can be converted into shares. Those are the only things that can be converted into share. If it's a call option will always be in money. Call option is to buy or to purchase. They will always be in money, because otherwise you will not exercise it. So you will not exercise, and they will always be rank number 1. Then look at these two, they could be rank 1 or 2, and we have done preferred shares that can be converted into common share, and we have done debt that can be converted into shares. You always need to test it. Why do we need to test it? We wanted to know, is this a dilutive or an anti-dilutive? So if it's more than dilutive or anti-dilutive, if it's a less than the basic earning per share, it is called a dilutive. If it's more than earning per share, it is anti-dilutive. So you always needed to check, is this more or less. I am done for the homework questions for chapter 17. If you have any question, ask me in the class, send me an email. I'll reply to it, or even send me a message on the right underneath the video, so that I'm able to answer your question. Thank you so much for listening to me, and good luck.